These companies need to be making trillions of dollars in revenue, 5 years, plus out in order to justify these investments. What you find is a pretty shocking underperformance of these companies that are aggressively trying to grow their businesses as opposed to those that are not. Alphabet has 21%, Microsoft 28, and then Meta 35, which is higher than the average utility at 28 today, and higher, by the way, than the CapEx spending of AT&T at the height of the dot-com bubble in 2000, which is only 21%. Before Most Dangerous World in the English language, or this time is different. What you find is that over the next 20 years after the crash, their sales actually 11x'd. So they actually did realize the promise of the internet, right? They grew very quickly. The problem is that at the same time, their multiples collapsed.
Hey, Kai, welcome back to Excess Returns.
Great to be back.
We always love having you on, and this topic in particular is going to be very interesting. So you recently, and for people that follow Kai, or even if you don't follow Kai, Kai has for a number of years been putting out excellent, awesome, interesting, and I think very useful and important pieces of research on Sparkline Capital, which is the website that that's his firm's site. And so on there's a whole series of articles. And just recently you put out an article. The title of it is Surviving the AI CapEx Boom. And we're going to talk through all the different, I think, things in this article and why it's important for the markets, the Mag 7, and just, everything that you wrote about, the historical context with big boom and bust and infrastructure and stuff like that. So this is going to be a really, I think, interesting topic. And it's very topical because there's tens of billions, if not hundreds of billions being spent on this, development and this build out with AI. But before we get into all that, obviously, Sparkline Capital is the website. The research is on there. You can also jump off to the ETFs that Kai's firm manages and just learn more about Kai and his background and the research that he's doing. So please go there and check it out. Okay, so I wanted to there's going to be a bunch of charts in this episode. So if you are just listening, you're going to get much more out of this if you go to the YouTube channel, our YouTube channel. But maybe to set it up, Kai, I was just, what made you, there was obviously something that it's all in the news and everything, but what was the genesis of kind of looking at this? Was there something that you just struck you, or were you just interested in how this build out compares to maybe what has happened historically? Give us the context here for that.
Yeah, I think it's the intersection of two threads. So as you mentioned, a lot of my work's around intangible assets. And what I see is this transformation of the economy from industrial to information-based and the rise of the intangible economy. And so this is an interesting kind of bucking of the trend where you have the largest companies in the world, which are these kind of asset-light money machines, like the Googles and the Amazons that just print money, start to turn away a little bit from the model that's brought them so much success. And the question is why is that? And is that concerning? And if so, why? And the second thread is, it's funny because I actually wrote my economics thesis on credit cycles. And, my advisor was this guy named Ed Chancellor, who was also my manager at GMO for a period of time, who's very famous for his work on bubbles. He wrote the book, Devil Take the Hindmost, but also on capital cycles. He's basically written the book on that. And so I've been thinking a lot about capital cycles and the role of, the supply and demand of investment in various sectors through time. And using that lens in this paper, of course, to try to explain and make sense of everything that's going on in the AI sector.
That's great. So help us put this in context. When we're looking at, in this first chart, we're looking at the spend of, Meta, Microsoft, and Google and Amazon. How much are we talking about in terms of, what these guys are putting up and expected to put up in terms of, the money in this infrastructure development?
Yeah, I think what's so interesting about this chart is, the acceleration we witnessed over the past year, maybe a year and a half, 6 quarters, let's call it, right? So obviously over time, these companies get bigger and bigger. So naturally you'd expect their, CapEx to increase. But you're seeing this kind of huge acceleration of CapEx, and it's now running at what's expected to be $400 billion over 1 year. which is a lot. And what's crazy is it's not meant to abate. It's not like a one-time thing. Oh yeah, like let's just like build the data centers and then kind of move on. Most analysts, whether it's McKinsey or Morgan Stanley Citi, expect this to continue, if not increase further over the next 5 years, and to reach levels cumulatively of somewhere between $2 and $5 trillion. And keep in mind that there's a lot of downstream consequences here too. It's not just the spending of these firms; it's also the utilities and the power and the data centers. There's a lot of work that needs to be done to kind of build out the infrastructure to make AI to kind of realize the promise of these exponential scaling laws.
One of the points you made in this initial section was the type of, or the amount of money that would need to be generated to, I guess, justify this type of spend. So you have this Bain estimate, I think, that something like, $2 trillion by 2030 in order to justify it. And that's the question that I've been kind of wrestling with. And I think a lot of people are, you have all this money being spent, but like, what type of return is going to be needed on that to justify the spend?
Right. Look, this is not the Apollo program, right? This is not this is not socialized money. This is money that's being spent out of private coffers, and ultimately on the behalf of shareholders in these companies, right? And so as a investor in a company like Meta, you expect a return on your investment. And that's the thing, which is if you're spending $5 trillion, I mean, there's some assumptions around depreciation, useful life of these GPUs, which we can get into later. It's kind of a hotly debated subject. You come up with an estimate that's in the trillions. Yeah, these companies need to be making trillions of dollars in revenue, 5 years, plus out in order to justify these investments. Now, the problem is that, their estimates range, but 20 billion, let's say, maybe 50 billion is kind of where we are now. So you need like a 100x increase in revenue to go from where we are now to where we need to go in 5 years to justify the, build out that's, being planned now by these companies. And that's not entirely impossible, but it's a pretty big gap. and one that, for as an investor in one of these companies, you do have to ask that question, which is, how likely is it that we actually do achieve that?
How much of the stock market's gains have been driven by like this small group of AI driven, or I guess AI oriented companies?
Yeah, so I cite this statistic by Michael Semblist at JP Morgan, and he says since ChatGPT's release, which is like November 2022, I think, 75% of the returns of the S&P 500 have been driven by AI-linked stocks. So that's these Magnificent Seven stocks like Google and Microsoft and NVIDIA, but then also a handful of smaller names that matter less, obviously, based on their weight. 80%, I think, of earnings growth and 90% of CapEx. Right, so these companies are kind of single-handedly moving the markets, as they have in many ways for the past decade. But ever since AI has become a theme, this very real investment is moving the stock market and the economy too, to some extent. I think some other researchers have come up with estimates that maybe around 1/2 of the GDP growth of the U.S. over the first 2 quarters of this year can be attributed to this AI spending and then the downstream ramifications of it.
Do you personally, when you see this type of like concentration or, a small handful of stocks, does that personally like concern you when you look at the market?
Yeah, I mean that's an interesting question. Like obviously we have concentration now of with the top 7 stocks, the Mag 7, at 33% of the index. In the dot-com boom, for context, at the height of the dot-com boom in 2000, it was around 20%. So 33 versus 20. So very concentrated. I think that's undeniable. Now, there's a couple of things to think about. So on one hand, you can argue that these companies are, conglomerates, that you could spin out YouTube, you could spin out AirPods, and they could be standalone companies. And so we shouldn't necessarily, think too much about the size of any one company. It's because it's just a conglomerate of many small companies. On the other hand, I think there is some risk. There's obviously the idiosyncratic risk associated with, one single executive or one CFO doing the accounting for a single company. I think there's also the risk that these companies tend to be very correlated, that they're all kind of like doing the same thing together in a kind of competitive arena, which we can describe more in the future, in this talk later. But these companies are all kind of tech companies that are operating, a handful of oligopolistic services. They're also all in this case investing in a single market, which is AI, right? They're all competing over this pie. which is obviously tricky to the extent that that ends up, going south. I also think that there's a valuation argument too. People have, I was actually emailing with a chancellor about this earlier yesterday about the fact that maybe concentration isn't bad in and of itself. But what happens is when your index is one third a single category of companies, all of which trade at, relatively high multiples that embed this expectation of, an AI future, that is what is potentially an area of concern. So it's more the valuations than it is necessarily the concentration inherently. But these things then tend to go hand in hand because indices being cap weighted naturally will increase their weight towards stocks as their valuations increase. And so you do tend to see concentration be high at the peak of a valuation cycle.
And we'll maybe get into just one comment on that. Like when all those companies are also doing business with each other and you have all these circular deals, it probably adds an additional element of risk to the mix,
Right.
But,
yeah. I mean, they're all like in bed together.
Yeah. And we'll come back to that point in a little bit. But one of the things Jack and I both really value this about your work is that you are trying to take like a historical context and looking at like history and what's happened in the past to try to draw some parallels to like where we are today. And in this next section, you sort of talked about other capital sort of booms that our country has seen. And this next chart, you kind of are putting it in the context of the spend for railroads, internet, and AI. And so I'll let you sort of talk to this.
Yeah, look, like today's not the first time that we've seen, the private sector build out the infrastructure for a brand new technology. 25 years ago, 30 years ago, it was the internet, which of course changed the world. And then before that, 100 years beforehand, was the railroad boom in the US. And so what you can do is you can say, let's put this current boom into the context of the prior ones. What you find is that, the relative to GDP, that $400 billion is about 1.3% or something. So, that's a number to start with. And then if you go back to the height of the dot-com boom in 2000, it was about 1%. Railroads were much higher, actually. So it was closer to 6% of GDP was being spent on building out the railroads in 1872. Now, the difference, though, is that the depreciation is very different between railroads and GPUs. So people estimate that GPUs depreciate at around, 5-year useful life. So 1/5 per year is what's assumed in most of the filings for these hyperscalers. Other researchers would argue that it should be closer to 2 to 3 years because of the accelerating replacement cycle of NVIDIA GPUs. But we can, for the sake of being conservative, assume take Amazon at their word, 5 years, fine, okay. The thing is that railroads last 30 years, right? You lay the steel, and even if there's a bust and no one's no trains are driving over it, it's still going to be there, right? And so you make those adjustments, and it turns out that on an annualized basis, we're actually spending more on the AI build out as a percentage of our GDP than the fiber boom in 2000 or railroads 150 years ago. So yeah, I mean we're right up there, in this kind of like at the record levels of spending for kind of the recent history of the United States.
That GPU depreciation thing is so interesting because I don't even know that like the people that are using them necessarily know how fast they're going to depreciate, because a lot of that is about how the level of innovation going forward and how fast these things are going to become obsolete.
Yeah, and can they be repurposed for inference or other tasks that may still have value, right? Because if you were to say, oh, well, let's just depreciate after like 1 or 2 years, which is kind of the replacement cycle for these things, sure, maybe you can't train state-of-the-art frontier models with them, but like they're not useless. You wouldn't want to write them down to zero. So it's a little bit tricky. I mean, it's interesting too, because actually what's happened is the opposite, where over the past several years, if you go to the filings for Amazon and these companies, they've actually been increasing the assumed useful life of these chips over time from like 2 to 3 years to 5 to 6 years. Now, is that the right thing to have done? Obviously, it helps them from an accounting standpoint to do that because they can depreciate these assets, the capital spending over a longer period of time, and therefore impact their earnings less. But is that like actually how the technology is working? And I think this is a really heavily debated topic. A lot of smart people have weighed in on both sides of the debate.
So this next chart is really interesting, the capital cycle schematic, because I think that kind of gets at the flow of this whole thing and how it might play out. So can you explain what we're seeing here?
Yeah, so this is actually from Ed Chancellor's book, Capital Returns. And what it describes is this dynamic where you have this exciting new technology, with railroads, it's the internet, it's AI, and companies rush to make investments to kind of win that land grab and win the AI race, so to speak. And then what happens is you find investors reward companies for these visionary investments, right? Remember when like Oracle announced the deal with OpenAI, their stock went up like 36% in like one day. So, the investors are still very excited. The market's very excited about companies who are putting, the bigger the deal, the better, right? The more money you say you're going to invest in AI, the more your stock price will go up. Maybe it's backwards, but that's the way the market is today. So what happens naturally is that every company wants to be an AI company, just like every company wanted to be a .com in the 90s, right? We had hundreds of companies launch railroads. Railroad companies sprout up in the 1800s. And so you see more and more investment into the space. Ultimately, what happens though is you have just too much investment. Demand, maybe it increases, but it just cannot increase enough to meet supply. And you end up with excess capacity, this glut of fiber, glut of, rail that, leads to a collapse in prices, right? We saw, I think 85% of fiber was unused after the dot-com bust, which led, the price of bandwidth to fall 90%. Over the subsequent years, right? And that's obviously bad for the builder of this infrastructure. So if you own an AI data center, you own a railroad, you own a telecom, not great. When prices go down 90%, you find many of these companies will enter financial stress if to the extent these companies took on leverage, as some in the dot-com boom did and most in the railroads did. You would face the legitimate risk of bankruptcy, and many of these companies did go bankrupt after the capital cycle turned.
Yeah, one of the interesting things, and I think this will be a thread we'll kind of pull out throughout this, is this idea is there something that's different about AI than these previous things? And I don't know exactly what it is, but I mean, we're kind of building towards a super intelligence or something like that. And does that change some of the stuff we can look at in history? And do we have to judge AI differently because of that? Do you have any thoughts on that?
I mean, look, like there is a state of the world that, whereby the progress on the research side of these AI models surprises to the upside, quicker and more powerful than we could ever have conceived. Half the workforce is laid off instantly, and then the rest of us follow. Where maybe it's just the last invention and everything changes. But that I don't think would be my base case. At least not over the next few years. And of course, these assets depreciate pretty quickly. This is a lot of money being spent in a space, and the but before most dangerous world in the English language, or this time is different.
That's very true. So what I love about your work is you bring together my world of factor investing with this world of technology. And that's what we're getting at here in Exhibit 6, because there's been a lot of research in terms of high asset growth firms and how they perform. So can you talk to this?
Yeah, so I took this chart straight out of the Fama French work. So, obviously Ken French and Eugene Fama won a Nobel Prize for their work on asset pricing. They have this 5-factor model, right, where it's market, size, value, quality, and or profitability. And the last factor is what they call let's call it the asset growth factor. And what that is saying, let's look at companies that had experienced high asset growth over the past trailing year relative to those with low asset growth. And then look at how they perform over the next year, that rebalance, and so on and so forth. So this chart shows that return stream over the past 60 years. And what you find is a pretty shocking underperformance of these companies that are aggressively trying to grow their businesses as opposed to those that are not. I think it's like 8.6 or something percentage points of underperformance per year, which you compound over 60 years, gets you to a relative return of negative 99.6%, which is not good. So these companies, have historically underperformed. And I think this is to some extent evidence of the capital cycle.
And this next chart, we're seeing the same thing, right? With high CapEx stocks.
Yeah. So obviously there are different reasons why companies can grow their balance sheet, and you can spend that money on a variety of things. I wanted to focus specifically on the most relevant variable, which is physical infrastructure, physical CapEx. And so looking at that one variable itself, saying companies that have high changes in their capital expenditures versus those with low, how have they done? And you find a very similar effect. One thing to note is that you do see, if you look closely, kind of acceleration of the underperformance into the dot-com bust. And that's, as we know, due to the fact that a lot of telecoms and other companies that were aggressively building out the internet, suffered undue losses, disproportionately large losses when things turned. But what's really interesting is that even outside of that one period, you find pretty consistent underperformance for these companies throughout the time period.
And you see it across sectors as well, right? What do you see in the sector data that you thought was interesting?
Yeah, I thought this was important. So like typically when you think of the capital cycle, you think of like a sector versus sector thing. So shale boom in 2010, telecom boom in the late 90s, early 2000s. But it turns out that like there's a lot of within sector dynamics too. So like take a given sector, say materials. If a single company in its sector is just for some idiosyncratic reason decides it wants to take over the world and build out like its business, and it kind of aggressively goes for it, that company will tend to have, on average, underperform its peers that are more conservative, right? So you're seeing both a cross sector, but also a within sector effect. And what's quite interesting is that this operates, we looked at the data across all 10 sectors and found that in every single case, this effect exists, that there's underperformance by companies that are seeking to aggressively grow their capital base. And by the way, that like communications, we know that's kind of a crazy situation. Maybe that's a fluke, but that's not even the worst one. Materials are actually even more impactful than within communications. And you even see some, both asset light and asset heavy industries in this mix too.
Yeah, and this next chart is interesting to me as well, because this is sort of showing what we're seeing now, where CapEx growth has been recently. And then it shows basically what we would expect, right? Which is not what you've seen historically, but what you have seen now, which is technology is where all the CapEx growth is.
Yeah, I mean, that's the interesting thing, because historically, technology has been a relatively capital light industry, but we started seeing like a reverse over the past year and a half with this big surge in building out the AI data centers, where you have 35% year-on-year growth in IT, 33% say in communications, 25 in discretionary, which is largely Amazon. So the Mag 7 and these big tech firms, include Oracle, are really driving a lot of this just from a kind of total dollar standpoint. But then you also see the downstream effects in real estate, energy, and utilities. These are firms that are kind of building out the power and physical data centers required to, supplement the chips and the models and all the other good AI stuff.
I don't know if you've looked at this, but is this like a lot faster than the dot-com boom? I mean, I was just coming out of college in the dot-com boom, but it does seem like the pace at which the spending is increased, like, is even faster than it was back then.
Yeah, I think it depends exactly on how you look at it. I mean, there are different components of this, but it's definitely, a big outlier event historically.
And one of the interesting things to me too, and you can correct me if I'm wrong about this, but it does seem like there's more, like the people that are spending the money, there's more of a winner take all feeling now than there was in the dot-com boom. Like, I don't think any of them thought like they were going to win the internet, but it seems like some of these firms, as they think they're working towards like AGI, they think there might be like a winner take all dynamic here, and maybe that's encouraging more spending. Do you have any thoughts on that?
I think it absolutely is. I think, these big tech CEOs have seen, how social networks have worked out, Uber versus Lyft, right? They see the dynamics of digital competition over the past 2 decades, and it's led them to this understanding that network effects and scale matter tremendously. And that's why, right, a VC company would subsidize Uber at a loss for years and years and years, because it will eventually become profitable and be one of the, I guess, 2 in an oligopoly, right? So I think firms are taking that same approach now towards AI, even though it's a much more physical, infrastructure-based industry than the kind of the pure software businesses that we've seen in the past couple of decades.
Yeah, as we move to this list of like the highest CapEx increase, this would be shocking to anybody, I think, if we looked 5 years ago, because these are all the firms you would expect not to have the highest CapEx increase.
Yeah, I mean, so you see Oracle here as the number 1 on the chart with a 249% increase in CapEx over the past year. Oracle's an interesting example because they were a little late to the AI race, but they've kind of come in and they've carved out like a really nice market for themselves, being this kind of more neutral, cloud AI provider in the space. And they've just been really aggressive making deals, like the OpenAI deal I mentioned and others. Just they're aggressively going for to become a player in the space that's historically been dominated by Amazon and Google and Microsoft, and Meta and Amazon are of course on this list as well, as is Nvidia. You also see a few guys who are kind of more in the who provide other infrastructure for data centers, so not the chips themselves, but you have like Arista, Amphenol, Micron. You also have Lam Research on the semiconductor side. And then you see Palantir, companies that are more like users of AI, but that are aggressively using it to, presumably win government contracts in this case.
Yeah, you mentioned that Oracle deal before. I believe like the money they've pledged to spend is significantly more than they even have at this point, right? I think they're gonna have to issue debt or something, as I recall, like just to spend the money. So to your point before, it's like a race to say who's going to spend the most money, even if you don't have the money right now.
Right. And they wild things that the market rewards that. Like the market's like, tell me how much you're going to spend. The more you spend, the more I'm going to make your stock go up, which is, kind of interesting because that's not what I would have expected, to happen.
Yeah, for those of us who lived through the .com boom, I mean, it was kind of a similar thing, not just with what we were spending, but if you put .com in your name, and so there's a tendency to want to relate it back to that. But also, I try to keep myself checked, like on the other side of this, and say, like, I don't know. I mean, maybe something is different about AI. I mean, these are very, very smart firms that are spending a lot of money. It'll be interesting. None of us know. We'll see how it plays out.
Exactly.
One of the things we've talked about a lot is, the Mag 7 have sort of been referred to as this asset light money machine. And one of the things we're seeing shifting in front of our eyes is this idea that they're asset light companies because they are spending their cash now like they haven't ever in the past. So can you talk about what this chart's showing us?
Yeah, I think it's helpful just to contextualize how dominant the Mag 7 have been, right? So over the past decade, they've compounded at 27.5% per year. And I did the math for this paper. That means they created over $23 trillion in wealth for their shareholders, which is just an ungodly amount of money. And, as the JP Morgan statistic showed, 3/4 of the return to the market of the entire S&P can be attributed to these 7 stocks, over the past couple of years. So these guys are kind of like the all-important pillars of the stock market. And then if you're an investor in the stock market, a third of your money is in these companies. So it's been great for you up until now, but now what happens? So this table you mentioned here, shows a couple of statistics. So the first thing we show is just how profitable these companies actually have been. So over the past decade, the return on invested capital of the Mag 7 has been 22.5% versus just 6.2% for the rest of the S&P 500. That's a pretty big gap. And if you look at return on equity or free cash flow margin, it paints a similar picture. And look, it makes sense. These companies don't need that much tangible capital. You don't need that much physical capital in order to generate these outsized earnings. What you need instead is you need intangible assets. And so that's the bottom of this chart where we show 4 different intangible intensivity metrics. We show that, at a percentage of their revenue, they're spending, much more than the average company on R&D and marketing. They have a lot more patents. They have, a much greater share of their workforce is in high-tech areas like AI. And so across the board, these companies are asset light. They don't use physical capital. They use intangible assets to generate these earnings. And that's worked out really well for them.
Yeah, well, I think this is one of the things people miss when they compare this to the .com is like, you just want to say, oh, those companies were overvalued, these companies overvalued. Like these are much better businesses. I don't know, you can correct me if you think I'm wrong, but these are significantly better businesses than the businesses I was seeing in front of me back then.
I'd say that is true. Yeah, they're better businesses. They have better balance sheets. They are more profitable. Obviously, there's going to be, core weaves in there. Like there are some companies as well that are more like the Global Crossing analogy. But your core companies, like compare AT&T 25 years ago to, Google today. I mean, Google is definitely the superior business.
Yeah. So as we talk about how that asset light nature is changing, we've got this next chart, which is Magnificent 7 CapEx to revenue. And you can just see that's gone off the charts recently.
Yeah. So like that's the catch, which is like, okay, these companies have done really well on the back of being asset light. But, the unfortunate thing for shareholders is they're now starting to turn their back on that model, moving from asset light to asset heavy. The CapEx to revenue ratio of this group of stocks has increased from in 2012 it was 4% to 15% now. Right, with that massive acceleration more recently, and if the streets to be believed, and what these CFOs are saying is to be believed, that's not coming down anytime soon. These companies are committed to the AI race.
Do you think like longer term they feel like they'll be asset light again? I mean, you said it's not coming down anytime soon, but do they feel like once we get to the other side of this, like they'll be asset light companies again, or do you think these companies are forever changed now?
I think they're forever changed. I mean, the depreciation of these chips is pretty fast. It's not like, oh yeah, we build the railroads one time and they're good for 30 years. It's you build these chips and they're good for somewhere between 2 to 5 years. So you're always going to need to be refreshing the chips, which are about 60% of data centers, 65%. So you have the physical component, the grid, et cetera, that's being built out. That's more permanent. But yeah, you're always going to need to be recycling these things, moving forward as the frontier, what is the highest end GPU continues to increase exponentially.
Sometimes you see a chart and it's just like completely, it's like eye-opening in terms of how serious or how much the change has been. And this next chart was one of those for me because you compared these companies to utility in terms of CapEx to revenue. What'd you find there?
Yeah. So what this shows here is it lines up all of Mag 7 from low to high. So you can see NVIDIA and Apple have pretty low CapEx to revenue ratios, whereas like Alphabet has 21%, Microsoft 28, and then Meta 35, which is higher than the average utility at 28 today, and higher, by the way, than the CapEx spending of AT&T at the height of the dot-com bubble in 2000, which is only 21%. And so that's the question, which is like, are the Mag 7 becoming quote unquote utilities? Like, obviously that's a bit of an aggressive statement and, there's plenty of qualifiers, but at least from a very high level, that's what this would suggest, that, they're transitioning from being kind of like, someone else do that, I'm going to focus on these kind of high margin things, to, all right, well, someone needs to build this out. Might as well be me. Let's go build out the AI cloud. And I think what's concerning is that if you look at the data, so similar to the Fama French work, right, where they look at like the performance of companies that have high growth in CapEx, if you instead look at the level of CapEx, so look at like for each point in time, the companies with the most capital intensive, the most CapEx to sales versus the least, you find that those companies consistently underperform their peers. Asset-light businesses are and have historically been better. Asset-heavy businesses have been worse. It requires a lot more upkeep. You have to keep spending money just to kind of offset depreciation, whether it's due to wear and tear or to obsolescence, due to technology. These companies, they tend to be in more competitive arenas where, physical infrastructure is just, there's lower barriers to entry. It's easier for folks to come in there and compete with you. Like Oracle just coming in and now they're likely to be a top player in the AI cloud. Not as hard as more intangible intensive sectors. And that's of course what leads to the capital cycle dynamic. Whereas if the barriers to entry are low and competition is high, then when returns are high or hype is high, competitors will come in and it'll create an excess capacity and that'll lead to, lower prices, lower profits, and then, they'll lead to a washout over time. So I think that's very much, likely to happen, given, this transition of these companies from this asset light to this asset heavy business model.
Kai, this wasn't in the paper, and I don't know if you know this or not, but what is Meta? Like, what are they spending so much on? Do you have any idea, like, what they're plowing the money into?
Yeah, I mean, AI data centers. I mean, Zuckerberg is a very aggressive CEO. I mean, we saw this with the metaverse, right, in 2022, when he made big investments in the metaverse, which he ultimately did pull back on. But in that case, he didn't really have any competitors. I think the dynamics here are very different with AI than what we saw in 2022. Right? That was almost like he was going on a limb himself and trying to make it a thing. Whereas today, like, everyone is doing this. And I think it's highly unlikely that we see these CEOs turn back.
And I have to assume some of this is a function of Zuckerberg feeling like he's a little bit behind. I mean, we've talked about like the $100 million people he's trying to hire. Like maybe the person who feels like they're a little bit behind is going to go a little more aggressive on the spending.
Yeah, I mean, there's certainly that element too. I think there's like a big kind of FOMO. There's a bit of an ego thing here too. A lot of different like kind of personality dynamics at work.
So this next chart was interesting because this gets at what has been one of the greatest things about these companies, which is the free cash flow they generate. And you're looking at how that's changing here as they start to spend money on this.
Yeah, I mean, look, the most common counter argument is the one, to this being a concerning development is the one that, you already brought up, which is that these companies are so much better than the railroads for sure. And then the companies in the .com, that these are not telecoms. These are, real profitable franchises. And that manifests in, free cash flows that have just been up until recently extremely insane. And but what you're starting to see is concerning because over the past few years, as the CapEx boom has taken off, you can see the net income line has continued to increase, but the free cash flow line has started to turn over. Right, these companies used to pay big dividends, and you can see now they're laying employees off. They started doing that. Like, I think a lot of this is because they're realizing, we're not going to. We need this money to build out data centers. Like, we don't have the luxury of just sitting on like infinite cash hoards like we used to. Right, like the investors used to criticize these companies, even several years ago because they were like, carrying on too much cash on their balance sheet. They weren't like they were, and now we have this opposite problem.
You mentioned these circular deals in the paper, and those are really interesting because those have been in the news a lot recently, and there seem to be a lot of opinions on all different sides. But first, maybe can you just explain when we're talking about circular deals, what are we talking about here?
Yeah, so these are situations where one AI company will either invest or either through debt or equity in another AI company who might be a customer or a or supplier to them, right? So it ends up creating this situation where all these companies are kind of interlinked, whether through equity or debt, in this web of intricate deals, and it kind of ties them together in a way where they kind of rise and fall together.
Yeah, it was interesting. I was listening to the All In podcast because as a value guy, that's where I get my tech information. And Brad Gerstner was defending these. And what he was saying is what's different than from circular deals in the past is that there is an underlying demand there. And so as long as there's an underlying demand there, these deals they are reflecting like legitimate revenue, legitimate demand.
Yeah, I mean, I think that, look, there's two things going on here. There's two things that are potentially concerning with deals like this. So the first one is like shenanigans, where like you're kind of like a shoddy company and you're just trying to make a deal to like prop yourself up, when you're otherwise failing. I don't think that's what's happening now. I think that, if you're Nvidia, you want to invest in and support these companies because they, OpenAI, for example, because their success also leads to more success for you. I mean, it's not like, I don't think that there's any kind of concern there. I think where the concern is on the second piece is this idea of like entanglement, where yeah, the Mag 7 have amazing balance sheets, and that's not going away anytime soon. But what's happening is that they're increasingly entangling themselves with firms like OpenAI, which are aggressively investing, money they don't have. Oracle, as you mentioned, is taking on a lot more debt. CoreWeave is, very financially constrained. To the extent that that's the case, they do put themselves at risk, even if it's not showing up on their balance sheets. And on that note, by the way, there's something I mentioned, which is the deal from last week, where Meta took on $27 billion of debt for the building of their Hyperion data center, but they did it off balance sheet. So they set up an SPV to take on the debt. It was the largest private credit transaction or offering ever, and they don't have that. That doesn't affect their balance sheet. It's not credit rating agencies won't look at that, but they are obviously backstopping that deal, regardless. So I think that's a good example of something that has happened in the past too. That is potentially a bit concerning. But again, it's less about like, does it signal fraud? It's more that it like just ties the fate of companies that have, very solid balance sheets together with those that have less solid balance sheets.
This next chart gets into the arms race that we've been talking about, which is this idea, well, you're going to build this big of a data center. Well, I'm going to build this big of a data center. And then somebody's going to come over the top with a bigger data center or more GPUs. And you talked about how that relates to the prisoner's dilemma. So can you talk about that?
Yeah. So the prisoner's dilemma is just a classic game theory problem that you probably learned about in college. But that does describe like a lot of dynamics in many ways, including the AI arms race. The setup would basically be this, which is, today we have this, basically a cozy oligopoly where these big tech companies have kind of divided up the, tech, various tech verticals, and, they take turns, two or three of them kind of own each one. And as a result, there's very little competition and they have very high profits, which is great for them. Now, the problem is that now AI comes along. And AI is this new disruptive technology, at least in the minds of these CEOs, that risks basically collapsing all these markets into one. Where it's not like there's like shopping and productivity. They're all just the same market. If you have the best AI agent, you win. And so now it's like winner take all. Going to your point, Jack. And if it's winner take all, now it's become a lot more competitive, and so they're going to have to vie for this new market. And the challenge is this, and this is where the prisoner's dilemma comes in. Because in the ideal world, what would happen is that these companies would kind of agree collectively to moderate their investment. Say, look, we don't want to disrupt ourselves. Like, this is a pretty good situation we have right now. Let's invest in the next technology. We'll do it like slowly, and we can maintain our monopoly status quo. The problem is that any single company is unilaterally incentivized to defect. In other words, they're incentivized to aggressively invest instead and try to capture the market. And what's happened in practice is that you have this, you have Google who invented the transformer, but they don't really want to disrupt themselves. And then you have Sam Altman in OpenAI who's like, wait a second, we have nothing to lose. Let's go for it. And so he's like going all in on this stuff, and he's basically bringing along these much bigger players with him. Because if OpenAI invests all this money in building out, artificial general intelligence, well, these other firms can't afford to just sit on their hands and watch them do that. They have to play too. And so what that leads to is, a different equilibrium where now everyone is aggressively investing. And what that means is you end up with, at least in theory, an oversupply of capital, an overinvestment, where now we have a stable equilibrium that is suboptimal, where these companies are kind of net losers, but because of the incentives to any individual actor, this is just where we end up. And that's the capital cycle idea, where you have, an overinvestment, an overbuild, excess capacity, overly high competition, falling prices, and ultimately low profit pool for the industry.
How much truth do you think there is to this winner take all thing? I mean, do you think that is the most likely outcome here, that like one firm is going to dominate this whole thing? Or do you think the most likely outcome is all these firms, well, maybe they'll develop different niches or something, and they'll all have successful businesses, and maybe it won't end up being as winner take all as people think?
So I think you have to be very careful to define like the different like layers of the stack, right? So like there's like the model layer, there's like the chip layer, and so on and so forth. I think most people think about the model layer as being kind of the most competitive, right? Whereas, I was doing this like in 2019, 2020, I was training my own large language models using open source, like BERT, for example, the original Google one, which was like a GPT-1 level model. And then over time, you saw OpenAI kind of quickly, pull ahead with their closed source models. 2 and then 3 in particular was very good. And so there was a period of time when they had their models were significantly better than everyone else's. But then you found, Gemini caught up, and a lot of even the open source models are pretty good now, right? And so there's a argument to be made that maybe what will happen is that there will be commoditization of at the model layer, where it doesn't really matter, like, everyone will just train on the same data sets, just going to use like the internet and like Wikipedia, so on and so forth. And you can have your own, in-house RL teams, et cetera, but like it's going to be pretty similar in that state of the world. And again, it's all comes down to competition, that there's not going to be much profits then in that category because there's too much competition, but there might be profits in a different layer of the stack. Say the guys who use the underlying intelligence, but then train and fine tune on a specific domain data set, or have distribution to end customers who really want access to that product or something like that. We'll see also at the chip level, like right now, NVIDIA had the monopoly for various reasons, including CUDA. Like obviously Google is trying to develop TPUs, and other companies as well. OpenAI made a deal with AMD, their chief rival, a week after the OpenAI deal. So look, there's competition entering that space. It's the capital cycle. Like there's no, if you see high profits in a sector, you're going to want to go as a capitalist, compete against that. And maybe you'll succeed, maybe you'll fail. But to the extent where there is less barriers to entry and less differentiation, you're more likely to see kind of perfect competition and zero profits, than others. So I think it's going to be interesting to watch how it plays out at the various levels, of the stack. But I do think that this, tendency towards an overinvestment is quite likely, right? You have like, Larry Pages on the record saying, I'd rather go bankrupt than lose this race, right? Like these guys are, really very much committed to trying to win this race.
Yeah, and just as an aside, at the model level, like I do feel when I use them now, like certain models are much better for certain tasks than other models. And so maybe there will be a nature where, certain models will gravitate towards certain types of tasks and be better at that than all the other models.
Yeah, I think that's entirely possible. I mean, a lot of the companies now are working on like these like vertical, for example, like you saw the announcement, I think it was last week, that like OpenAI is like, hiring like investment bankers to like train their model on the Excel for financial modeling, right? And we're seeing that as well in the legal and accounting fields. These companies are starting to do that, to build kind of vertical applications of their models. So that could be where we end up, where maybe like one model is the best at like a financial application, another one is the best at, taxes or something. So that's possible as well.
So just one more from me before I hand it back to Justin. You've got this interesting chart, and we went way back here. We looked at railroads. You looked at the cost of railroad construction and earnings and contribution to GDP. So what do we take from this?
Yeah, so this is from Azim Azar, who writes an excellent blog. And what I wanted to do was just go back here and understand, like, where is value captured, right? Going back to the AI stack idea, right? It's all about competition in these big infrastructure booms. And this is an interesting case study of the railroad boom. If you look at the purple line, you can see like the annual cost of railroad construction, and it kind of fluctuates, right? So like around 1870, it looks like there's a bit of a peak, and then the panic happened and it collapsed, and it peaked again, then collapsed, boom and bust, boom and bust, boom and bust. And if you look at the green line, that's the revenue, or the earnings, of the railroad industry through that time period. And you can kind of see these periods where like the costs, they could go through a building cycle and then they crash, right? And each time that happens, you see this big wipeout. Hundreds of railroads go bankrupt, and there's a consolidation, and then they kind of do rinse and repeat. So that happened for a period of 20 years, right? That the industry really struggled to make it through. And then eventually, they made it to the other side, and, profits started to climb, and, costs kind of stabilized, the build out more or less finished with these, long useful life for rails. And, then moving forward, like railroads are a industry, they're not extremely profitable, but they're not bad, right? They exist. What's really interesting is you can see the third line on this chart is the contribution of the railroads to GDP. And that line basically went exponential even as early as like the 60s and 1860s and 1870s, and then just like took off. Right. And what's amazing with this chart is like the extent to which, the railroad industry itself didn't make any money in round numbers, but yet they contributed such a huge share to GDP. So who actually won? Right. That's the question. Obviously consumers. Obviously, if you're a business trying to ship stuff from, the West Coast to the East Coast or vice versa, if you're a consumer trying to take a ride, but so it's the customers, whether businesses or individuals, that did do really well. And like another example would be like the dot-com boom. This is like a classic case study where, as I mentioned, after, Global Crossing failed, they, the price of fiber went down like 90% went down 90%. And that allowed companies like Netflix and Facebook to then, build out massive businesses on the back of this subsidized internet. So basically what's happening here is like two categories. There's the infrastructure builders, the telecoms, the railroads, and today the data center builders. And then there's the customers of those services, which are the Netflixes and Facebooks in this example. And you're seeing, because of the overbuild, what happens is that it means that the infrastructure builders get hit. But what then also happens, interestingly, is they then subsidize their customers because like the competition brings down prices, allowing these companies, their customers to thrive. And so that's why it does make you question, without even getting to the final section, whether or not, where you want to position in the stack. Maybe like infrastructure is not the place to be. As we'll see, as I've shown, like in other places, in the beginning of a cycle, like think about the dot-com boom. In the beginning of the dot-com boom, actually telecoms were the best performing sector. They, handily outperformed the general tech sector up until 2000, and then they collapsed 92% and never recovered. So, there is a argument that it's dynamic, but if you look over the long arc of time, in general, you found that the railroads, the telecoms were not good investments. Yet the companies that they served were actually quite benefited by the technology. And to the extent that there is an overbuild, which maybe there will be, maybe they won't, you're actually positively exposed, right? You're anti-fragile, I guess, with respect to CapEx if you're in this other layer.
And so I think that plays into this next part, which is, where are the opportunities? And what you had done a few years ago is publish this paper, Investing in AI, Navigating the Hype, where you actually built like an AI investment financial analyst to find where maybe some of these hidden opportunities or under the radar opportunities might be. So maybe before we get into what those might look like or what those are, just talk to how this like financial analyst, like what type of data did you use and what type of process did you use to come up with this investment strategy?
Yeah. So look, there's like, going back to the framework, there's two categories. There's the infrastructure players and then the early adopters. So infrastructure, they're kind of obvious. NVIDIA, other chip makers, CoreWeave, et cetera. Like, JP Morgan had a list. But the early adopters are harder to find because, when I say early adopters, all I really mean is the everyone else section of all other companies, the companies within that mass that are actually investing in AI and not just talking about it, right? So one thing that we've seen since that paper came out over the past, 2 years has been like an increase in the amount of chatter in both filings and earnings calls of CEOs talking about how they're doing AI, right? Everyone's saying they're doing AI because it's good for the stock price. But you need to get away from that theater because anyone can say they're doing AI who's actually investing in this technology. And that's where, a lot of the unstructured data and alternative data that is described in that other paper comes into play. So things like, trademarks. You would get a trademark if you're planning on launching an AI product, AI-powered product. Job postings or, LinkedIn bios of your employees. So we're trying to find like these kind of hidden signals for companies that are, truly investing or positioning to use AI in their businesses, as opposed to just talking about it or not even at all.
Were there any names that kind of really surprised you that kind of rose to the top? I mean, I'm seeing like Caterpillar in here, Walmart. I mean, these are big Fortune 500 companies, obviously, and all in the S&P 500 that are, trying to incorporate the use of AI to help with operations, help become more efficient, do all that kind of stuff.
Yeah, I mean, look, I think the use cases of AI, if it is indeed a general purpose technology, should be basically everything, right? Whether you're, automating like the robotics in your factory, or your supply chain, or you're doing predictive analytics on your customers if you're a retailer, or drug discovery, there should be use cases across all industries, not just in software, right? So the obvious names are like Palantir, of course. Everyone associates Palantir with AI, and they are using it. But you find a lot of other companies that maybe are kind of later in that journey or sort of earlier in that journey, but that are, relative to their, say, stodgier peers, still incorporating technology in a way that's, hopefully will meaningfully give them an edge over the laggards within their sector.
And what about on the sector level? Like, what did you find there that might be interesting? I mean, obviously, the AI infrastructure is all in communications and IT. Well, consumer discretionary too, to some extent. But was there anything that sort of jumped out at you?
Yeah, look, there's this exhibit we looked at, like for each sector, it's market cap. What percentage is in AI beneficiaries, either early adopters or infrastructure, and then what percentage is not. And what you found is that, on the infra side, communications, IT, and discretionary, which is just Amazon really, have a pretty high concentration. And then there's some in energy, real estate, utilities. So similar to what we saw with the CapEx growth chart. But what's kind of more shocking and more surprising is that the early adopters are way more spread out, right? So of course, technology and communications, those are kind of naturally going to be the first place you see, adoption. I actually, in that other paper, did a chart where I showed, based on an occupational level, which sectors' workforces are most exposed to LLM automation. And aside from IT, it was financials, which I guess interestingly shows up as a third on this list here, right? All our jobs. And then industrials, healthcare, consumer staples. So you're seeing like, yes, there's less penetration within healthcare as in IT, but it's not that different, right? The much more balanced exposure than what we saw on the infrastructure side. And I think the same thing applies if you go to the geographic thing. So we basically do the same breakdown, but this time by country. And we say for each country's based on their own individual market, what percentage are AI beneficiaries versus not. And I guess on the infrastructure side, what you see is obviously we all think of the US as being kind of an AI market. And it is like AI stocks and AI infra stocks are a big percentage of this market. But you got to remember the supply chain is also global, right? You have ASML in the Netherlands, you have TSMC in Taiwan, and relative to their much smaller markets, they're actually even more AI exposed, right, than the US. And the same point can be made on the early adopter side, which is, the US has lots of companies that are pretty modern and thinking about AI. But in fact, Germany and Israel are actually scoring even higher as a percentage of their total smaller markets on AI early adopters. And then even after the US, it doesn't drop off that fast. It's like Japan, Switzerland, China, Canada, we're all pretty serious about this. So I think the thing is that like we all know that if you invest in the S&P 500, you're going to get a lot of AI exposure. But what's interesting is if you also invest in, say, the German DAX or whatever, like you're actually getting pretty decent AI exposure too, just because the markets are so much smaller. Like, we don't think about like the German companies doing AI stuff, but like, the market's just so much smaller as an overall percentage. You're still getting meaningful exposure.
And what about capital intensity? That's the next chart with infrastructure versus the early adopters.
Yeah, so this goes back to kind of the Mag 7 chart where we saw, CapEx to sales go from like 4 to 15. You're seeing a similar dynamic here where there's always been a gap between the more asset-light early adopters, which tend to be more like, software or whatever, and then the infrastructure players, right? So in 2015, it was like 6 percentage points for AI early adopters and then like 9 for infrastructure. But that gap has widened over time. So now AI early adopters have a CapEx to sales ratio of only 4, and infrastructure firms have like 15, right? So that gap has really widened a lot and is not set to come down, right? And to the extent that, you believe the argument from earlier that empirically we found that asset-heavy industries and businesses are inferior. They have lower returns on capital. They require a lot more capital just to kind of tread water because of depreciation. That's a concerning thing for this segment.
Yeah, and that sort of plays into, this next chart showing just how much of a premium valuation that these infrastructure plays have relative to, the early adopters. And I think in your paper, you said that these valuation premiums, maybe since 2015, I don't know if that's have, gone from 32 to 137%, which is pretty crazy.
Yeah, I mean, that's the other thing, which is like I mentioned earlier that like in the dot-com boom, the telecoms actually outperformed the beginning of the cycle before they didn't, right? And that's the same thing seems to be happening here with infrastructure stocks, NVIDIA, these obvious, AI, big AI infrastructure companies have really outperformed over the past few years. And kind of left behind, these more under the radar names like Caterpillar, right? I guess they've been okay actually, but that as a category, that group has not really appreciated in the same way that the kind of more memified or hypey infra stocks have.
So walk us through, this is like a walk down history lane kind of. So this is going back to the dot-com boom and bust and sort of what happened with the NASDAQ index relative to the telecom index. And then as you go through that, you make the point in the article, and this is something that I think a lot of investors that didn't go through that period might not know, that, the fundamentals of a lot of those companies that made it through actually did really well for like a decade, but their stock prices basically didn't recover until like a decade later, or until like maybe '09 to '10, whenever it was. So walk us through that, because that's a very important thing to, I think, understand when looking about, at these boom and bust cycles combined with valuations.
Yeah, look, I mean, this goes back to the idea from before that like, just because I think AI is a transformative technology doesn't mean I'm going to make any money investing in the stocks that do that. And the same thing applies here, where there's two ways to lose money, right? One is, I would call it fundamental, which is you spend $1 trillion building our data centers that no one uses. Okay, so that's, you just like wrote off $1 trillion of CapEx. But the other one is not even that. It's valuation risk. It's asset-light companies, let's say, who, aren't actually putting up that much money. But the thing is that their stock valuations, their multiples trade at pretty high extremes because investors are assuming there's going to be tremendous growth in the future. And the problem is that, if those valuations revert back to a normal level, you will lose money and you may never get it back again. So even asset-light companies and asset-heavy companies as well face valuation risk. All companies have this. And in the case of the dot-com boom, that was the main driver of losses for these dot-com darlings. So basically what I show here is starting in 2000, a basket of kind of high-flying dot-com stocks. And what you find is that over the next 20 years after the crash, their sales actually 11x'd. So they actually did realize the promise of the internet, right? They grew very quickly. The problem is that at the same time, their multiples collapsed. So their price of sales was 33 going into the bust. It fell to like 5. That led to like an 85% return over like 2 years. And if you look at the blue line, that's just a combination of fundamental growth and then multiple compression, just mathematically. And what you find is that the total return went down 80% in the first 2 years after the bust, and then it took another 18 years to claw your way back out to back to break even. But yes, they eventually made it, right? But like it took many years to get back. Which is not a great outcome for investors.
Right. And so you sort of then asked the question, like, if you were to take your framework for assessing intangible value and trying to buy those companies, then, using a more sort of, the way that you look at intangible value, which I'll let you talk through what those are, what did you find there in terms of the hypothetical performance, at least?
Yeah, so let's talk about the framework first and like why it's even required. So like, your starting point should just be to use the tools that are kind of widely available, which is like price to book ratio. We mentioned Fama French as a starting point. The problem with like traditional value like that is that it tends to be very focused on tangible capital as like a definition of intrinsic value. And what that means is that you're naturally going to be biased against companies that are asset light, whether it's, companies with strong brands or human capital, or more relevant in this situation, companies with strong intellectual property. And the whole point of investing through a hype cycle is to be long innovation. Well, you're going to miss out on all those companies, right? You think about traditional value investors through the dot-com boom. There are many famous examples of guys who just sat out the entire thing, which, of course, lead to missing out on a lot of upside. So is there a better way of doing things? Is there a way where you can remove that anti-innovation bias, still be long innovation, but also have a value filter whereby when stocks get overheated, you can rotate out, take profits, and move to other ones, and then kind of recycle. And that was the idea here, which is if we improve our valuation ratios to include not just tangible, but also intangible capital. So you're now looking at price to a more holistic definition of intrinsic value. The idea would be that we can now approach these periods and just the tech sector in general in a way where we can now apply the value lens into the sector without just being always hating tech stocks, which is kind of what we show here in this, again, hypothetical performance in this chart here, which is to show that like basically the gray line shows if you just took all internet stocks over this period, what would happen on a relative basis, so relative to the market. And you would find that, you beat the market for the first half, and then you like underperform the market after the bust, and it was a full, beautiful round trip, like a perfect round trip, which is not a great outcome. So is there a better thing you can do? What if you instead did this, where you divided the universe up into a cheap half and expensive half on intangible value, and each month rebalanced? So you dynamically rebalanced as stocks got expensive, you would, kick them out, or as stocks, fell in the bust and got cheap, you'd buy them back. That's what the blue line shows. And so if you do that, you achieve, a decent performance, a consistent performance, both in the boom and the bust, outperformance against the market. The problem is that the expensive half of stocks basically fully offset those gains. So whereas the cheap half outperformed, the expensive half underperformed, exactly offsetting the gains over this period. So what you want to do, obviously, if this is to be the indication, is you want to, own the cheap half. If you just stay away from the expensive stocks, you can still be long innovation, still be long the internet, and that beautiful green line, that fundamental growth line, the 11x in sales we saw, while also avoiding a lot of the pain from the bust associated with this multiple expansion compression risk. So you're trying to take valuation risk off the table, and that was the goal. That was what we tried to demonstrate here, and how that would have worked in this episode.
Yeah, that's great. And people in that 2023 article, you can see kind of what type of names would have been in that portfolio back then, if that was based on what your system was finding attractive. So if we were to take this process and framework of intangible value and apply it to the AI universe, what would the portfolio basically look like today?
Yeah, so about 20% would be in infrastructure stocks. So again, like I'm not saying they're all bad, but just on a relative to how they were before, it's a little tougher place to play. So you still have Google and Amazon in here, and Micron, the other example being given, and then the other 80% or so would be in early adopters, and that's across not just technology but also financials, communications, industrials, consumer discretionary, healthcare, consumer staples, and energy.
Mm-hmm. And what about how it's shifted? So in 2020, you had a certain framework or a certain type of exposures, and how has that sort of changed over time here?
Yeah, so that's the interesting thing, right? This is all bottoms up. It's all looking at like the valuations of these companies relative to their, intangible augmented fundamentals. And so in 2020, the portfolio would have been almost half infrastructure, of which chip makers, so like NVIDIA and other semiconductor companies, would have been a large component. And then early adopters would have been, maybe 60%. So that shifted, obviously, away from infrastructure companies. As infrastructure companies, as we saw earlier, have become more and more expensive as like the market now fully values NVIDIA. Those companies have been kind of rotated out of and then into more of the early adopters, which continue to be under the radar and, also more asset light.
This is awesome stuff, Kai. What do you think, if you were to try to bring all this to some type of conclusion, the way that investors should be thinking about the markets today and, investing in these types of companies, and also even the Mag 7 we've talked about a lot, like, what do you think sort of the final conclusions of this paper are for you?
Yeah, I think all right, so if you go to the capital cycle, what's the main insight of the capital cycle? The insight is that people underrate the supply side. Everyone's here trying to figure out, what is demand going to be? Is revenue going to 100x, right? Will OpenAI continue to, be the fastest growing consumer app ever and monetize their users through Sora? Maybe, maybe not. That's a really, really hard thing to predict. But what we do know is the supply side. we do know that these companies are making tangible investments into infrastructure. We can see the deals. These are, multi-year deals that have to be done. It takes years to build power plants and such. And we're seeing that it's happening, right? And so you can project that forward, hundreds of billions, trillions of dollars of capacity will be coming online over the next 5 years, unless something drastic changes. And so I think that with that in mind, and that's more like a pretty narrow confidence band. And with demand, could really be anywhere. You have to ask the question, which is, if you are invested as a stock market investor in the index, you have 33% of your money or whatever in the Mag 7 and probably 40 something percent, across the major AI infra stocks. Like, is that where you want to be? Given, what we learned about history and given, the amount of capacity coming online, that you need to, see a heroic increase in AI revenues in order simply to justify that. And perhaps there are, more, there are other ways of investing in AI. So you still want to be long innovation. You still want to be long AI. I think, like many people, that it'll be a transformative technology, but you want to do so in a way that maybe is less exposed on the capital intensity side and perhaps less exposed on the valuation side as well.
The one thing I'll say too is that these types of, I guess, cycles, the boom and bust aspect of them, a lot of times, to your point, it's like people are asking questions later. It's like spend money, invest. And I feel like this is one of the first pieces I've seen, at least, that is really, and it's not questioning anything. It's just the reality of like the way that these things sort of shake out, at least historically, and looking at how this is like transforming the market and these big companies like right underneath our feet. And so, I think that it's great that there's people out there like you that are thinking deeply about this stuff, because it's, hundreds of billions, probably trillions of dollars, decked up and invested in these companies. And, the outcomes here are going to be pretty important and massive. And so really appreciate, you doing all this work and certainly sharing like all this with us. We're very fortunate. We get to sit down and our audience gets to learn from you. So thank you very much, Kai. Really appreciate it.
Thanks for having me.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.